And it's turning. Hello, everybody. Can you hear me? I hope everybody can hear me. Can you hear me, Cal?
I can hear you loud and clear, Guy.
Marvellous. Thank you very much for joining us today for this broadcast. We're going to be talking about capital allowances today, and our guest, I was going to say my guest, make it all about me. It's all about me. Our glorious guest is Cal Byers from Yes Tax, who's kindly volunteered to come along and be a spokesperson for capital allowances and to talk us through tax reliefs that are available for businesses. So we're going to pretend that I am a business owner, and we're going to talk through the time from buying a building through to fitting it out, and then we're going to point out at the various stages of the purchase and the fitting out of that business unit the types of reliefs that businesses can be aware of, or should be aware of, or to bear in mind that they might get some money back from HMRC if they do particular things. So, if I set the scene, then Cal.
Absolutely.
And let's hope I've remembered the right example. Otherwise, we might be in trouble. Right. So I run a business that makes widgets, and so I bought a business unit that I intend to fit out with the machinery I need on the ground floor, and then I'm going to put it in a upper level where I'm going to put the offices, I'm going to put toilets, I'm going to have a boardroom, and the sort of admin sort of things upstairs, and all the physical assets are going to be downstairs. I'm also going to put charging points outside, so my employees can charge their electric cars when they come to work, so they can do that. And that's what I intend to do. So
absolutely.
So I bought it. So away you go with what things to look out for on the purchase of a building.
Yeah, so there's a lot there. So it's jumping out straight away. You've got two kind of big opportunities to think about. You've got the purchase of the building itself, and then the subsequent fit out. Now, both may attract, well, the fit out definitely will. The purchase might attract quite a decent chunk of relief, tax relief, through the expenditure you've incurred there. So if we think about the purchase first, I mean, how much have you spent on your building, Guy?
Well, I've won the lottery. I won Euro Millions a couple of weeks ago. I've now got £1 million sat in my offshore bank account in the Cayman Islands, which HMRC don't know about, but that's the subject of a different broadcast. So I spent £1 million on it, and I'm going to probably spend another £500,000 fitting it out.
Brilliant. So, I mean, thinking about the million, I guess two questions. Are you entitled to any relief for the purchase? And what amount might you expect if you are? So the first point, you have to look at the property history. You have to look at who owned it before, how long for, what they might have claimed on it themselves. And if you're in a situation where there's no claim being made and you can make a claim, you might expect between kind of 10% to 30%, depending on the type of claim, of the purchase price as a deductible amount. So of that million, that could be, if we say take the middle figure of 20%, you could say 200K of this is going to qualify for capital allowances. That would be a tax saving of 38K once you take the 90% of that. Okay. And how determining entitlement, as I say, is based on property history. We would just tend to look back in the land registry documents, look at the contracts, and determine that based on the legislation. But definitely an opportunity to kind of keep in your mind, because they are often missed, I'd say, purchase claims.
Yeah. So okay, that's the existing one. What about if I bought a new unit? It's just been built. It's a brand new business park. It's really convenient for delivering my widgets around the UK. It's easy for my staff to get to, and so I bought a brand new one.
Perfect. So, I mean, that will be, obviously, it'll be in the hands of a developer. The developer will hold that asset as stock, which means they're not going to be capitalising that expenditure. So, the relief available through capital allowances is only for capitalised expenditure. So, we know in that case, the developer is not going to have made any claims. They wouldn't have been entitled to claim. So, you will be entitled to all of the qualifying assets in that property on purchase. So, again, that will be to the higher end of that range, towards the 30%. And you will be entitled in that case. And so, you should definitely do a purchase claim. Yeah.
Yeah, so the business unit I've bought is basically bare. It's got a few electric sockets in, but it hasn't been fitted out. They've all been sold as empty carcasses, if you like, for people to move in and fit them out as they need. So I'm going to do my 2 floors with my machinery on the bottom floor and my offices on the top floor.
Yeah. So on the purchase, as you say, it's just a shell. There will be bits and bobs in there, as you say, the electrics and the lighting and things like that. these are all qualifying assets. But you'll probably get much more interesting and generous reliefs on the things that are in the fit out. So I mean, if you've got the shell, what are you going to do to the shell to make it your own, really?
Right. So with all the machinery I've got, I'm going to have to put much more electrics in for downstairs. Have much more electrical capacity. I'm going to put toilets in downstairs as well for my staff. As I said, the charging points outside, and upstairs. There's going to be much more electrical up there because that's where I'm going to have the much more lighting up there for the offices and for the printers and all the things, the laptops and PCs I need up on the second floor. So there's a lot that I need to put into the building to make it ready for me to move in there.
Yeah, brilliant. So when we think about what assets qualify for what reliefs, generally your kind of equipment and your furniture and the things you use to carry out your trade, they're what we call those main pool assets, and they're going to qualify for the most generous reliefs. Then you've also got your kind of integral systems in the property, so your electrics that you're probably going to upgrade as part of your fit out, your water and your lighting that you might also upgrade to kind of fancy LED or something like that. That's what we call special rate. Also qualifies for some quite generous deductions, and particularly the super deduction that was announced as part of the March 21 budget. Massively generous relief. It means for any main pool expenditure, so this is your machinery, you're getting 130% deduction. So say you spent 100k on your machines, putting them into the property, you're getting a deduction on your profits of 130,000, equivalent to a tax saving of 25k. So you're getting 25p back on every pound that you spend on your machinery, which is definitely very generous. And then you also mentioned there the charging points. So there's also another specific relief for car charging points because it's an environmentally friendly asset. You'll get all of that back in the first year. Well, without one of these more enhanced reliefs, you might be looking at a kind of an overtime situation. So we're always looking to kind of apply these enhanced reliefs, such as the ones you might get for electric car charging point.
So I should know this myself. I'm trying to think when the super deduction. When does the super deduction end? Has it got time limit on it? I can't remember.
It is. It's a 2-year window.
2-year window.
Introduced April 21, runs up to April 23. The logic being, the corporation tax rate is obviously planned to increase in April 23. So you might be in a situation where companies are incentivized to delay their investment so that when they get the tax relief, they're getting it at that higher rate. So to counter that, they've introduced a super deduction, 130%. And if you do the math, 130% times by 90% is effectively 25%. So you're getting the benefit of tax relief at a higher rate, but earlier on. So that coming out of COVID, there's all this investment in that 2-year window. So if you've incurred expenditure between April 21 and April 23, the super deduction is going to be massive, I think.
So from a cash flow point of view, if you're a business and you're moving premises or you're in existing premises where you're intending to invest in some new machinery, so say some machinery become obsolete and you're looking to buy something new, it would make sense to do it before April 23 because the tax relief in cold hard cash for the business will be more than if you wait till after April 23. That's
absolutely, yeah. More or equivalent. It certainly won't be worse.
Yeah. Okay. Right. Okay. So we've talked about the fitting out the property. So timing wise, then when we're so what type of as I'm speaking to contractors about and I'm agreeing a schedule of works with them and saying, right, these are my plans, this is what I want you to deliver, and I'm agreeing a schedule of works. Presumably that would be really useful for quantifying the claim. What other sort of documents will help quantify the claim that will be required to quantify a claim? Absolutely.
So our starting point will kind of always be fixed asset ledgers. What has the company spent in the year? And that'll be a starting point. Often the kind of cost you spent on contracting will come through on there, just as kind of stage payment 1, stage payment 2. There's not going to be that level of detail. So it is definitely key to be speaking to the contractors as you go along, making sure they're preparing the right schedules that are going to set everything out in the detail that you need. A lot of what we do when we're involved in projects is we will have those conversations as the project's still ongoing to make sure that that detail's there. And so that when we come to do the claim, do the analysis, we've got all the support we need to kind of get the best answer. So the contractor has a really kind of key role. Over and above that, sometimes floor plans can be really useful. Certainly, in purchase claims, we often look at floor plans. Any kind of building reports is always nice to see a kind of before and after and understand a bit more about it. But it always starts with the ledgers, and then we kind of drill into the detail from there, I'd say.
Do photos help? Not of you, Carl, but of the work that's been done inside a building. Are they useful to substantiate a claim, to show like a before and after, to show the work that's been done to a building? Do they help?
It certainly helps. I mean, it's not always required. That might be overkill in some situations. If we don't want to send a client around the building, take lots of photos if they don't need to. But anything that helps us understand the assets, understand the works a lot better, specifically in lieu of cost information. If there isn't really enough kind of invoices and costed out schedules, then we would then look other ways of kind of costing things out, maybe through evaluation exercise and things like that.
Okay. Well, that leads me nicely into this question from Victoria. So we've talked about the paperwork that we would need, fixed asset registers, talking with the contractor for the schedule of works. Would you need to actually make a site visit to quantify the claim?
So it's definitely a good question. And the answer is, it depends. It depends on the level of cost information available. It depends on if that is going to be sufficient. I mean, particularly with purchases. So, I mean, if you're doing an improvement project, you're likely to have documents from the contractors and things like that. You're less likely to need a survey. With a purchase claim, the exercise is basically looking at the building as it exists when it's been transferred and saying this asset is this and this asset costs this much. There's not going to be a schedule of works from the contractor because it might have been built a long time ago. So that's when surveys can be really useful for basically doing evaluation exercise. So we would be more likely to do a survey in that situation, I would say.
So a survey would probably be more practical and useful if I was buying, and as the widget business owner, if I was buying existing premises already owned by which has already been used by a different firm who've already done some work to the actual business premises. Well, if I was moving in there thinking, right, I need to make some changes for the machinery that I'm taking in there, then that would be more appropriate for a survey to see because obviously there's going to be more in there than it would be if it was an empty shell.
Yeah, absolutely. Yeah. So it comes in that purchase situation. You want to go in to see what the state of the building is when it changes hands, definitely.
Okay. Right. Now we've got he's a very unpleasant character that's asking this next question. And I hope you don't mind him asking it, but he's based in Sheffield. Right. And I'm really hoping the question comes up as it should do in the minute. If I press the right button and I go there, there he is, this dodgy geezer. So he has a question for you. So if the company undertakes qualifying research and development, R&D, and uses certain capital allowances for this activity, is there some additional tax benefit available? Thank you, John. I didn't mean to be unkind much.
So it's a great question, and definitely is. So it's probably, in my experience, one of the most missed capital allowances is RDAs. So I'm sure a lot of clients will be aware of the R&D tax credit that you get on your kind of revenue spend towards carrying out R&D. But there's also relief for your facilities in relation to R&Ds, which is referred to as RDAs, or research and development allowances. So whenever you're buying a building or building a building or even refurbishing a building to then use it for some kind of R&D purpose, development, testing, design, whatever it might be, you get entitled to this RDA relief. And so that offers 100% of the spend in the first year, which is kind of on par with annual investment allowances or comparable to the super deduction. But there's one very major difference in that annual investment allowance, which is 100% up to the first million, super deduction, they just apply to qualifying plant and machinery. So the assets we talked about earlier, being equipment, being lighting and electrics. But the RDAs applies to the whole building, including your structural spend, which without RDA is attracting the slowest form of relief in a very slow percentage year-on-year rate. So RDAs give the opportunity to claim, all in the first year on structural spend, which can be massive.
So I make widgets. So if I thought, right, there's something else I can make that my customers will need that might help. So say I'm developing something that has some sort of environmental benefit, And so I think, right, I think I can be a market leader in this. I'm going to design a particular part for for solar panels or for, biomass or something or other. Yeah. So if I allocated part of this floor space then, and thought, right, I'm going to try and design it, and I'm going to try and build it in this separate part of the buildings tucked away. And so that's what we're talking about here. If there's something like that going on, where you're trying to develop new products within the business unit,
yes,
this is the type of
absolutely anything innovative. I'd probably leave it to my colleagues to determine what the qualifying R&D is, because we've got many of them that specialize in that, and then I'd come in and say, okay, we know they're doing R&D that qualifies. To what extent is this new building used for that purpose? And then that will inform the extent to which we make a claim.
So when you say the extent to which the building is used, are you talking about floor space, or are you talking about the amount of time and effort spent in
floor
the space?
Space.
Floor space. Right.
Yeah.
Okay.
And the time factor, I mean, if you have a building, you build it, you use it for R&D projects for a year and then use it for something else, doesn't matter. That's will still qualify for that first year. And there's no clawback once you change purpose, because obviously building companies going to be flexible with how they use the buildings and as is required by the business.
Yeah. Okay. So so say I'm buying an existing building then.
Yeah.
And I've gone in there, and I can see lots of work has already been done by the previous owner. Sorry, I'm just going to get rid of John's face because it's
spilling with rage.
Yeah, it's just too much. So if I'm buying an existing building then, and I'm moving in there, they've already done a fair bit of work. So say, for example, they've already got the offices in there, so I don't need to build separate offices for my staff doing all the admin sort of stuff. But I'm still going to do something. But I can also see there might be a potential for a backdated claim, because obviously if I've bought a new building, I've got nothing to backdate it because I've done nothing with the new business unit.
Yeah.
But if I buy an existing one and see work is already done, could I make? I know it's a bit sneaky and it might be a bit, I was going to say immoral, but it's not immoral. But say they've done something and they haven't claimed the tax relief. Is there anything to stop me as a new business owner from claiming the tax relief on what's already been spent?
No, not at all. And, it's someone is entitled to relief on these assets. So the mechanics of it would be either the person selling the building was entitled to claim but didn't, whether they were motivated to, whatever.
Yeah.
In that case, you can claim kind of on their behalf, and then the allowances are transferred through what we call an S198 election. So we do quite a lot of that, and how it tends to work out is that we hopefully are involved before the sale completes. We'll put a bit of wording in the purchase agreement to say the vendor and purchaser will cooperate on this capital allowances claim, but it will be at the purchaser's expense. They'll sort out the analysis. The transaction then completes, and then we do our analysis. So it doesn't delay the completion of the transaction, because you can do it after the fact. And we go and we figure out how much they were entitled to claim. We put it in this election so it can transfer from vendor to purchaser and do it that way. And then the slightly more straightforward situation is if the vendor was never entitled, but you are entitled when you buy it from them. So, for example, if the vendor, as we talked about, was a developer, or if they were a charity, a charity is not within the charge to use corporation tax, they can't claim any allowances. If you buy a building from them, it's likely that you're going to have all of that entitlement when you make that purchase. In that case, you don't need any corporation. It's much more straightforward. But you can still get the allowances that a vendor might not have claimed, for example.
So if I was buying an existing building then, and I had to speak to the previous vendor, the previous owner, to see what they claimed for, if I made a claim and it was accepted by HMRC, would I have to give the previous owner any of the claim that I'd made? Because if they should have done it when they owned it, why should I commission them to do all the work and then have to give them some of the money back?
Well, that's a negotiation point, really. So this election that transfers between the two parties is agreed between the two parties. And it can be any figure. If they've claimed the allowances, they can choose to pass them all on, or they can choose to pass none of them on. That's really a bargaining chip when it comes to purchase price. Practically, what we find is that we get involved when the vendor just isn't motivated to pick up allowances for whatever reason, or they've overlooked it. We just say, we're going to do this exercise at our expense. It makes no net gain or loss to you. It doesn't affect their finances whatsoever. So they don't really mind. We're doing the work, we get the benefit of the purchase. They're happy that we're happy because we're more likely to complete the purchase because it's more appealing. So it is just a bargaining point. That election is an agreement in terms of how much you want to transfer. Equally, if you're selling a building and you've got all these allowances, you don't necessarily have to lose them when you transfer that building. You can just keep them and transfer the minimum amount in that election. Again, that might annoy your purchaser, but it depends on the negotiations.
Yeah, well, presumably, if you were selling it, you'd want to claim all the allowances you can on the building before you sold it.
Absolutely.
That would be the logical thing to do. If you knew you had them there, you just claim them all and then.
Or use it as a bargaining chip and say, there's all this allowances you're going to get when you buy it. It's going to make it more of a commercial decision for you. You entice your purchaser in. That's all, on the table. So it's definitely, but it's often overlooked, really. Apathy is the main reason that we find it is underclaimed in our kind of vendors when it comes across our table.
I suppose it also depends on how quickly you need to sell the building. If you've got time to make the claim.
Yes, although you can do it after the fact.
Oh, so I could sell it. I could sell the building to the new purchaser and then make the claim after I'd sold it.
So you can claim the allowances in an accounting period where you still owned it, because you can go back and amend tax computations, 2 years in arrears. But then you have to consider what happens on the disposal, and so you pull the allowances and then you decide what value you're passing over, and that's your disposal value. So if that's £1, that means you're basically keeping all the allowances, or if it's all the balance, then you're passing all over. But again, that's in agreement with the buyer. They need to agree that election.
Okay. Now I'm going to see if I can master this. Master another question. So this is from Nigel. Now I like Nigel. He's a much nicer character than John. So Nigel's question is. And I can see on the comments that John's going to get me back. But anyway, so Nigel says, is there a central register of what's being claimed on properties, or is there some way to find out the claimed capital allowance before buying a property? Now, that's a really good question.
It is.
Because you might want to. Yeah, because if you buy an existing building with lots of capital allowances in and they haven't claimed, and then you sort of ask the question to try and find out what they've done, you might alert them to something they've missed out on.
Exactly.
So it's a really good question. So
it would be very lovely indeed if there was some kind of central register, although I can't imagine it might be quite tricky to monitor. So there is no such thing to know. The way we tend to find out is we will try and get tax computations. We will look at CPSE replies. Sometimes it's talked about in there.
Yeah.
But most of the time it's about entitlement. We can see because of the entity, if it's a charity or a pension, or because of its history in some way, that it never had entitlement in the first place. That's the easiest way to confirm that they haven't claimed.
But if you're making a purchase as part of the due diligence, couldn't you sort of be a bit sneaky and say, oh, as part of my due diligence, I would like to see your fixed asset register for what you've already got in there? Wouldn't
in theory,
that might not tip them off as to what you've got in mind when you take it over.
The issue is, the requirement isn't just that they've never claimed. If they are entitled and don't claim, you can't then necessarily claim because they could have. So because of the requirements brought in kind of 2014, if it's there to be claimed, it either has to be claimed or it's lost, essentially. So if they're if they have entitlement to that spend, they're going to have to pool it and transfer it. That's the only way you're going to get it. If they don't have entitlement, like if they're a charity, then it's yours. So it's the principle of first entitlement. So the first person who's entitled to claim it needs to, or it's essentially going to be lost. And they need whether they claim it, transfer it, or they claim it and keep it. It's that first entitlement, I would say.
Right. Okay.
So that it isn't a sneaky exercise. Usually, it's usually when we put our wording in the SPAs, it's because they're just not really motivated by it. They don't think it will be a material number, and then we do our analysis, and it's just good news for the buyers. They're happy that the buyer's happy and the transaction's gone through. Yeah.
Okay. It definitely sounds more complicated when you're taking over an existing premises than if you're just buying it new and fitting it out yourself. It's obviously much more simpler then, because you know what you spend, you know what your spend is, you know what you've put into the building.
Yeah. Plus the information from the developer will be really good, so you'll have a great idea of what's in there. But we love the complexity, that's why we are often get involved.
But that's because you're a geek. That's why you like it.
Put the glasses back on.
Yeah, I was surprised you took them off. Gives you an air of gives you an aura.
An aura of knowledge. Well, I don't want to give it too many false pretenses, to be honest.
We want to get John wearing glasses. That might improve his
I'll help with client meetings. Yeah.
Right. Something that this is a question from Liz that we haven't really touched on yet. So, what's the structures and buildings allowance now? This is this a bit like is this one of these things that's more of a slow burn? Is that a good way to describe it?
Certainly. Yes. So it was introduced in 2018. Prior to then, you would get no relief for your kind of structural side of things. So we've talked about how kind of equipment and systems qualify. The structure of the building didn't used to, but now it qualifies at 3% straight line per year. So quite slow. And another kind of catch. So your foundations, your steel frame, your walls going to get this 3% per year. That comes off your base cost of your capital gains calc. So if you sell the property, it's effectively clawed back. Now that's not true for any other capital allowances, which is why they're so attractive. So even if you're claiming lowers on your equipment and stuff, it doesn't affect capital gains. But structures and building allowances is the exception. So it's definitely valuable because there's often quite a lot of spend on structure if you're going to be keeping the property and don't really plan to sell it. And you can own it for a while, so that 3% can come through each year, and over time you get the benefit. But
Yeah, so
it's not a headline kind of 100% kind of thing.
Yeah, so it'd be more beneficial for a business that's buying a unit that they intend to stay in for a while, and gradually get the benefit over a longer period of time, get a bit of tax relief every year rather than all in one go.
Yeah, and you can claim all the allowances in combination, so you'll get all your super deduction and stuff on your plant and equipment, and you'll get your annual investment allowance on this kind of functional stuff as well as the SBA. It's not either or. You can't claim the structure stuff on the non-structure spend. So you use it, all these tools in your toolbox to get as much as you can. But
I don't like to talk about my toolbox too often because you lead the conversation a different way. Right. Okay. So really, what we've talked about then, it really is. There's a lot of things to think about, particularly if you're buying an existing business, which somebody has obviously been using before and has fitted out before. Right. Is there anything else you think would be useful? How would you make a successful claim? I mean, if people want to go ahead and they think, right, I think I've got a building here where there are capital allowances to claim, and it would help me cash flow for my business if I made a claim, got some money back from HMRC. What needs to go in a successful claim? And you have 3 minutes.
Yeah, perfect. So my top tips essentially would be think about it in a fairly timely manner, because all the best reliefs have a 2-year time limit.
Yeah.
That said, if you think you've missed something in the past, still worth having a look because there is still relief there for you. So think about it. If it's a construction or a purchase, maybe ahead of the game before it goes through or before you start work. And then get an idea of what allowance is going to be available to you. Speak to your accountant, speak to your advisors. That'd be my first tip. The earlier you think about it when you're doing a capital project, the better.
Hang on. You need to speak to us, not to speak to other advisors. You need to speak to us. Come on, now get the message.
Speak to Guy.
speak to us too.
So that'd be my first tip.
Yeah. Okay.
Second tip is get good information. The purchase is quite straightforward because you need contracts and things like that, which you'll have anyway. For when you're doing work, make sure you've got breakdowns of the costs, whether it be from a contractor or invoices if you've done the work yourself. Make sure that information exists, because that's going to help separate the assets. So they're the two kind of biggest hurdles. It's just kind of spotting that there is an opportunity, and making sure you've got the support that you need to do it, really.
Right.
Yeah.
Okay.
And then the mechanics of the claim is if you have a report, or if you have some kind of analysis, it will just go in with your tax comp, and you'll get that tax saving when those comps are submitted.
Yeah. So in the report that goes into HMRC to claim the relief, it isn't just a question of sending in loads of documents to say I've spent this. You need to actually do a tax computation as well to say, right, here's the evidence that I've spent the money. This is the work I've had done. This is the date when I had the work done, and here is the tax computation for the relief.
Exactly, and the analysis of the expenditures, what relief you're using for each different asset and things like that, that needs to be in there as well.
Yeah. So I suppose how long does an average report take to research and write and submit on average? So obviously, some will be quick if they haven't spent much money. If a business owner hasn't spent much money, they'll be quite quick, but a more involved one, I think, might take a bit of time.
Depends on the size of the information. Once we've got the kind of info, it's probably 2 or 3 weeks. We can certainly get them out in a very timely manner if we're against the deadline. So,
okay,
yeah.
Here we go. Very informative, gents. Good presentation. Thank you, Nigel. You're my favourite attendee.
You did say he was nice.
Yeah, he is nice. Much nicer than John. I don't know whether to finish on the. Shall I let John have the last word? John's last word. So, right. Thank you, everybody, for watching. I hope you found it informative. If you need any, we do have a really handy fact sheet if you want some more information to have a read through of scenarios and the type of things that can be claimed for. If you want to send me an email, I'll happily send the fact sheet out to you. You can get some more information and then you can give us a ring if you're interested in the services that we're offering. So that's guy.smith@gorange.email. Or you can obviously drop me a DM on LinkedIn and I'll send you the fact sheet and then we can see whether you can claim a bit of tax relief from HMRC and give you a bit of extra money in your business. Okay. Thank you everybody for watching. We do appreciate it. And have a nice weekend. Thanks, Cal.
Pleasure. Enjoyed it.
Bye-bye. There we go. End broadcast.